So like I said, for many of us here, this will be very routine. And the fact is that, and which is why many people try to shy away from teaching their strategy, especially if you're somebody who loves followership. Because once it's been taught, then there's nothing more to be taught, right? But we'll keep getting new people coming in, questions here and there. We'll try to take out time to explain. So you notice, I also noticed that some of us ask questions with the answers very, very clear in previous recordings. So I'm beginning to feel I'm not a good teacher. Or perhaps those people just don't want to go bend down and learn. All right, so we'll start up right now. Okay, so I'll be taking the questions, and I believe if there's any other thing we can explain as it goes. So how to include the weeks in LSV? Do we need to include previous week from the candle which we are considering, or the next of it? All right. Now, I don't want you to see this strategy as too complex. It's basically price structure, just price structure. Whether you want to see it on the ICT angle or even the retail angle, it's basically just price structure. Now, if you understand the candlestick anatomy, you would know, and let me annotate again, sorry, I'm used to that. You would understand that, especially for Forex, it may not happen for stocks and the likes, a lot of gaps in there. But in Forex, most times, right, the close of a candle coincides exactly with, say this is a down candle, the close of that candle coincides most times with the open of the candle to the right of it. And you can see that clearly on the screen here. You can see that clearly on the screen here. The close of the bullish candle here, the bullish hammer, the close was up there, and that was exactly where the open of the bearish candle was, and it traded down. Notice also, maybe I will do this on, let's do this on 30 minutes. Yeah, 30 minutes will make a lot of sense. 30 minutes. Very good. Notice that the close of this candle coincides with the open of the bearish candle. Now, because you are in 30 minutes time frame, it looks like you had two candle pushes to the top. That's what it looks like because you are in 30 minutes. If I box out everything here and I go down to 1 hour, you won't see any bullish candle, right? In this point here. You are seeing, let me do it this way. These two bullish candles showed up, but let's go to, let's say 4 hours. You won't see any bullish candle inside that spot. So that was a pullback inside the 4 hours, right? Now, why am I explaining this? Let's take this, for instance. This was the bullish candle. And this candle here had a wick to the top side. If I want to mark my order block responsible for the drop, I mark everything here, including the wick. To the upside. It is my assumption very well in the market here, push price all the way up and push price down. I want to cater for the buyers in this region. And we are being consistent here. I remember Darren Flynn mentioning to us that when we draw our fibs on the higher time frame, we should consider the wicks. Why? There is volume in that wick. There is volume. In fact, we could mark this up and find out there's 28 pips in that wick, right? So when marking up your order blocks, consider the wick of the candle to your right. If price is going to make a pullback, price can as well pull back all the way to the top of that wick. And if you don't consider it, you easily get stopped out, and then price finally goes in your direction. You want to consider the wick. Same thing happens for a buy. If I were to consider, let's find one that meets. Okay. I need one that meets that criteria clearly. Okay, very good. So if I were to find, if this were an order block, for instance, and I was to mark up this for a buy, I would do this together with the lowest point. I will assume that when the candle closed at that point and the new candle started, sellers were still actively in the market, pushed it all the way down before the buyers came and gave us a rally. I want to consider this wick. I always want to consider the wick to the candle to the right. You want to see what happened in the candle to the right. So I think that answers the very first question about using candlesticks or the wick. How do we include the wick? Yeah, I think that explains that. And this is the same for all time frame. So if you want to go in using LSB, this is it, right? And I also want you guys to know here, we had some arguments in the group on within the week, a healthy one for that matter, a very healthy argument for that matter, right? But I want you to know that if you use the concept of LSB, you can use it on any strategy. And you can frame up your own strategy based on LSB alone. In fact, organize a Zoom. I will join. We'll break down the strategy and see how we could, what matters at the end of the day is making money from the market, right? Look at GBP sell, right? So let's forget about source, forget about everything. Use LSB alone on H4. This will be the bullish candle responsible for the drop. Price never took it out. This will be the bullish candle. No, this low here didn't take out this low. So we will not use that. We would be using this, right? This low didn't take out this. This didn't take out this. Therefore, we can't use this as our order block. Neither can we use this bullish candle as our order block, right? This took out this point. So this becomes our bullish candle, right? And if you've been following us, this order block is a strong order block. This order block here is a strong order block. Go watch a video, cursory look on order blocks. We tried breaking that order blocks into strong order blocks and weak order blocks, right? We tried doing that, and we said several times weak order blocks could be violated. I use weak order blocks as points where I get, say if I was in a trade for a sell and price closes above a weak order block for a buy, I might just at that point take out some of my profits, because there's a tendency that price will go back to a strong order block, right? Go back, watch that video on strong order block. We defined what a strong order block is. It has to be leaving a point of consolidation, right? Liquidity has to be taken out, and to be able to do that, you have, let's say you have your, sorry, I'm not on MT4 here. Let's call this up session breaks. Okay, right, check. If you find that one of these points here happened to be yesterday high, and price takes out that yesterday high and drops quickly, that is an indication of a strong order block. Let me see if there's a way I could do this easily. Let's go back to MT4. Go back to MT4. Get to GU. Let's get to GBP USD. Then we were on which date was this? 11th of May. 11th of May. Am I right? Okay, 4 hours. No, 4 hours. 11th of May. Very good. Right. So if I box out this zone, I box out this zone, and I drop down to 15 minutes. I want to see this area here take out liquidity, right? Now, this was yesterday's low, watermark for yesterday's low. Price traded, went back, and came back down, giving an impression that price is respecting yesterday's low for a sell. Price came back, took out the liquidity at yesterday's low, and dropped swiftly away from that point. I mean, the low of 2 days ago now, right? So this gives me, this coupled with the fact that it was leaving a point that looks like consolidation right here, gives us a definition for a strong order block, right? So that was just an addition. Let's go back to what we're trying to explain ab initio. So this was the order block responsible for this low. Notice how price didn't take out that order block, dropped further, gave us another order block response for this low. Price came back, didn't take out this order block. This is an example of a weak order block. This is an example of a weak order block, right? If you want to take a trade off a weak order block, you should be using additional confirmations to take a trade off a weak order block. Or it should be that you're adding on to a winning position with a smaller. Now, I hope we haven't discussed how to grow small accounts, and how to stack. We haven't discussed it, right? If you're stacking, one of the things you should know is never enter a new position with a lot size higher than your original position. So if you're in a trade on a 0.1 lot size, you're 100 pips down, don't take a new trade with a lot size higher than 0.1. Because what it does is that if you run into a drawdown, it wipes up everything you've made using your first trade. If you are stacking, you should be doing that with at least the same lot size or something smaller. So it puts you in a safe position, right? Now, this is an example of a weak order block. Besides it being an example of a weak order block, you have a fair value gap here, clearly that has not been filled. You should anticipate that this rally up might, and I'm using the word might intentionally, because in spite of what anybody might say, we are basically speculators. We only look for high probability trades. We aren't guaranteed anything, right? So taking a sell off this point should be with added confirmation, which you can do on your 15 minutes if you use LSB, right? So here also, you notice that there were some fair value gaps here. Price actually just came here, filled the fair value gap, and dropped. We also gave this scenario here as a trade setup on its own. I have friends who trade nothing but this. They just identify a clear downtrend. Once they identify a clear downtrend, they look for one candle engulfing. What do I mean by one candle engulfing? An engulfing candle that clearly engulfs a bullish candle. Like in this case, the downtrend. This is a bearish candle clearly engulfing this bullish candle. They put their first entry at the tip of the bullish candle. Then they put the second entry at the threshold. Those of you that understand the ICT term, the middle of the bullish candle, that would be their second entry. And the stop loss would be spread times 2 above the high, right? Now, their trade objective would be to clone this engulfer, including the wick up. Clone it, and the trade objective will be to get out here. So I'm getting in here or here, and I'm getting out here. It's as simple as that. This is somebody's trading style. And who are we to fault it if he's making money off it? Right? So I want us to develop that independent mind. If you have a trading strategy before that has been making money for you, this strategy, what you're learning here is not the best in the world. If it works for you, fine, use it. But this attitude of jumping from one strategy to the other won't pay out all the while. So those guys, for instance, this would have been another bearish engulfer. So what would they do? They simply pick this to this point. And clone it. And anticipate price to trade to the tip of this candle or the threshold. Will they have made money here? Price came, picked this, came halfway, straight to their SL, maybe some pips, maybe not. That is somebody's trading style. You work out yours, right? So back to the questions again. Yes, that is the way you use that's the way you use the wicks to the candles to the right. If you understand the candlestick anatomy, that if price is dropping, it could continue to drop in the next candle before a rally up. And if you understand how ICT uses its order blocks, and I think I explained it in the last video, you see it very, very clearly that something that looks like an order block on your 1 hour, when you go to the weekly, it might not just be an order block. So you have to understand that we're trading this off the 4 hours, so we could have possibility of trading, having like 1 or 2 trades per week. That is why we trade on the 4 hours. The downtrend on the 4 hour might just be a pullback on the weekly or even on the daily. So you also want to have those lines, in perspective when you're trading. Back to the questions. Okay, does order block work in a ranging market? Well, institutional order flow, unfortunately, is the trend following strategy. Secondly, which is another unfortunate statement, we don't know when a market will range. I'm yet to see anybody. Well, let me not say we don't know. I don't know when the market will range. So what do? I simply trade what I see. I don't know if a market will range. And when it is ranging, I don't know when it will break out. You might use TDI squeeze. You might use some other indicators to try to preempt when price will actually eventually do a breakout. But the truth is, who knows? Nobody knows when price is going to start ranging. We could anticipate using BTMM Rose method that at level 3, we're expected to range to give us a 2-2 trade or whatever we want to call it, right? But it's still an anticipation because we just reset and continue buying for a bullish scenario. So nobody can give you for certain what price will do. And because we don't know if price will continue to trend or to range, with this strategy, we simply trade what we see, right? So in a ranging market, yes, it works, but your take profits, your trades will look so lazy and so clumsy, and sometimes you feel like trading is not working. But anybody who's profitable in trading knows that you have to be comfortable in an environment that is full of uncertainties. Now let's look at this scenario here. Let's look at this scenario in this place, this area here. And I'll use this to explain something. So we have this order block responsible for this buy, this order block responsible for this up, order block responsible for that up. And then what do we have here? A break in structure, right? We have a break in structure here that might have, for many people, meant that price is going down, right? But by order flow strategy as taught in SimplyPips, we would be seeing this as a break in structure and all this push up as possible retest of what would have marked up as a source for us to sell. But it never happened. So 2 things could have happened here. It's either we lost this trade. In fact, 3 things. It's either this was the sell here would have been a losing trade, or we might not have gotten an entry for an LSB sell, or if you understand order blocks, you would see this close beneath this order block here as a retest of this order block. Now I know I'm sounding confusing, and let me explain further and hope you understand it. Now, if you are used to ICT material, the way ICT explains order block is slightly different from the way we use it in the institutional order flow. In the institutional order flow, we basically just use the last bullish or bearish candle depending on the direction we're trading, right? So this last candle here will be an order block, but this will also be an order block. And if you understand the concept I just explained of a friend who looks for large engulfing candles in a trend and tries to wait for price to come back to fill the gap up to the tip of the engulfing candle, you would see why he would win this trade, and traditional institutional order flow traders may lose the trade. It's as simple as it's easier to explain in hindsight. In the heat of the market, you have to be one way, either a buy or a sell. And if you lose, fine. If you buy, fine. We'll move on to the next trade. If you win, rather, right? So if you want to take a trade off institutional order flow, and you have a healthy engulfing candle like this with a gap in between, you should anticipate. Go watch that video again. Costly look on institutional order flow. I'll add the link to the description of this particular video so you could easily spot it out. You should anticipate that this gap should be filled, right? So when price traded down and rejected, that might be a reason to buy. And if you're not comfortable, simply just let the trade go and look for something you are comfortable with, right? So back to the questions again. Okay, is setting profit targets using the void? Do we use void on our main time frame, that is H4 only, or we consider other lower time frame? All right, setting targets using voids. I watched a video by Michael, and those of you in the mentorship class, the modified IOF, I shared that video with you. It's on YouTube, it's a free material. And he said entry, most times for him, is not an issue. Exits, on the other hand, is an issue. Unfortunately, that is the point we get paid. At the point of exit is when we get paid. After all the markups and analysis and everything, we get paid at the point of exit. So exits should be something you have back tested and you're confident with. Prof is on this call, and I don't think Prof uses other blocks, gaps, as reasons to get out of a trade, right? And he's a profitable trader, I can tell you that. He uses R's. So if he goes in with 1 R, meaning that if he's risking 30 pips, he would be anticipating to take his first profit perhaps at 1.4 R or 2 R, like I would do, 30 pips, then you get it out at 60 pips. Fine. Now, but if you also have a fair value gap on your chart, like we have here, to this point, the fair value gap, you would anticipate that price may trade to fill in this gap, right? So if you were in for a sell, then this area might be an area you would be anticipating to take profit from. Or in fact, if you want to go in for a buy, you might be anticipating a reason to buy off here, right? Like it happened here. There's a gap here. But if you're not comfortable with using gaps, because it is highly subjective. So you see someone like Darren Flynn says he used like 5 or 6 confirmations. If gaps are as powerful as we try to make them look, we just trade safely, simply on gaps alone. But no, they are not as powerful as it sounds, right? They are, yes, useful, but you want to have, a confluence of reasons to be in a trade or to get out of it. So yes, you can use gap, and of course, gaps on higher time frame are more powerful than gaps on the lower time frame, just as the trend in the higher time frame is more lasting than the trend in the lower time frame. So you mark up your gaps just as additional reasons to want to hold on to a trade, get out of a trade, but that may not be your sole area of take profit or stop loss. You just anticipate that price could get there. And however, if you have an order block and you see price trading down into the order block, let's use this example here. So let's say we have an order block here and price is trading down, and for one reason or the other, we got an LSB somewhere within this doji, and you know that there's an order block and there's a large engulfing candle, large candle here, you should anticipate that price will come into the order block. You may want to sit out this buy and see if price will come in, or go in with a lower risk and anticipating that price will eventually get to the order block. If anybody tells you anything with using words that sound very certain, run away. That's a scammer, right? Run away. We anticipate that price will get there. We now use other confirmations to take our trades. And let me tell you, sometimes we can use the 6, 7, 8, 11 confirmations and still lose the trade. But we are happy that we have worked based on our strategy. Losing a trade is just part of it, right? So you anticipate that price will come. If you wish to know, I used to have a mentor those days that says, whenever you see a large candle, he didn't understand order blocks. Then when you have a large candle like this, you should anticipate that price will come back 50% of that candle. There might be another reason. Find what works for you and stick with it, right? So yes, back to the next one. So Moon, I think I've answered that. Moon plus, in setting profit targets using the void, do we use the void on our main time frame, that is H4 only, or we consider other lower time frame? Use the voids on the higher time frame, and if you have one in lower time frame, you could consider it, but the higher time frame has more. I went to previous YouTube videos, but still wondering, considering weeks. I think I've explained, except you came in late, I explained weeks, right? I explained weeks. If you're going in for, where was that? I think I saw an example. I explained weeks not long ago.
He had asked the question before you gave the explanation.
Oh, okay.
So asked at the beginning.
Okay, yeah. So I can move on then. If the higher time frame is showing a sell, is it advisable to sell only in the lower time frame? Yes. One of the very first things you learn as a trader is that the trend is your friend. I wonder who coined that word, but it seems to work. The trend is your friend. If the higher time frame is showing a sell, it is advisable only to sell in the lower time frame. Now, I'm aware that as retail traders, we are almost captivated by this. We're looking for a strategy that will give us the possibility to catch everything in the market. Whether it is buying, we catch it. When it is selling, we catch it. When it's consolidating, we catch it. The truth is this: if you try that, the market will catch you. Rather than you catching the market will be the one catching you. You trade in line with the trend. And even when you trade in line with the trend, you could still lose. But what is happening there is that you're putting yourself in a position to have high probability trades. And one thing I want to state here also is that when you're trading institutional order flow, try to spend more time on your 4 hours than on the 15 minutes. The 15 minutes can get you confused. The 15 minutes will make you feel like price is dropping heavily and I'm missing out. You need to come back to your 4 hours to just see what is happening. And you simply know that I need to just wait for the right time to buy. Without institutional order flow, you could trade market structure like I explained in the part 1 of IOF, ICT versus BTMM, and trade well. Notice what happened here. Notice we've been having these drops, right? We've been having these drops. Market structure, you're trading market structure, you've been having this, and all of a sudden you have a close above 1. What do we say? We expect a pullback. And the pullback, we expect it to turn back between 1 and then we'll pull. Then we expect it to come back again and turn back somewhere between 3 and 4. That's exactly what happened. And then we pull. Just market structure alone, without institutional order flow, we could have done this, right? Market structure alone without institutional order flow. So what institutional order flow does is it helps you not to guess. So rather than guess, you want to say, okay, I will go in when price approaches a certain region. When price approaches a certain region, then I will be willing to buy off that point, right? So that's what institutional order flow does. It just gives you that region where you feel price might make a U-turn from. So higher time frame, yes, that's just it. Somebody said no volume. Wow. Okay, Victor. Okay, thank you very much. Okay, so like we are considering weeks in LSB process. If there is a body or candle before, after, then candle, which we are considering, then we consider. I didn't get that. I didn't get that. Would you want an opportunity to speak? Let me know. Akash or Harry, can you help me understand this system with the 15 minutes time frame? Why not? That's why we're here. Okay, but before then, let's discuss what happened on sometime within the week. So we basically have price was making higher highs. At this point, let me make this thicker. At this point, this bullish candle was the highest point, and price was dropping down, right? At this point where we have this bearish hammer with a point some pips slightly above the bullish candle, I automatically adjust my source to be the highest point. I am not loyal to the color of the candle. I'm loyal to the concept, the highest point. And that's why I have this indicator on my chart. It tells me which point is the highest point. This is the highest point. So if price comes back and trades, I will still be anticipating that it gets to that point. It helps me to put my stop loss in a better position. So traditionally, this is the bearish, this is the order block, right? But if you watch a video on order block, we're trying to look at the highest point. So I'm picking this as my order block. And that will be my source in this case. Then this candle here, sorry, happens to be the breaker. So happens to be the breaker. Price broke beneath it. And once price broke beneath it, we had a push up, barely touched the source and dropped back down. Now we have this as an order block. Notice I captured the wick of this candle. Notice I captured the wick because this is a bullish move up to that point before dropping. Price traded into that zone and dropped. Here we had an argument, right? So when price dropped, this was the bullish order block, gave us this. Now, responsible for this drop, right? Then it gave us this bullish candle. Traditional institutional order flow. This is not an order block yet, right? But with the concept of lows and highs, this is an order block because it gave me a lower point. It gave me this lower point here. This is the bullish candle responsible for this low, right? To be able to trade this properly, I now decided to pick this bearish candle inside this bullish candle, and I called it my breaker. The reason why I did that was that I wanted to use the normal ICT concept of this being the last bearish candle that was traded above. So upon this pullback down into this point, we're buyers, right? Now price got to this region here, and other people who didn't mark up this area as an order block were anticipating sells here, and price traded into this zone. So let's look at what we would have done traditionally without looking at this in the hindsight, with the benefit of hindsight. So if you, two scenarios now, if you were not seeing this as an order block, as a lower low, let me use it that way. If you were not seeing this tip here as a lower low, you would be anticipating a drop down and didn't see that. So in this zone, you'll be anticipating a sell. Here, you'll be anticipating a sell here, for which price traded into this zone and then gave an opportunity to sell all the way down here. Now, the question I expect to get from this class is that when price closed above this zone, does that automatically make this a breaker and this a source? And the answer is yes, based on the traditional institutional order flow. This would have been a breaker and this would be a source. And all of this sell down here would have been missed because you'll be anticipating that price is coming back into the source to give you a buy. So you could have missed the whole of this. There's nothing we can do about it. Does this strategy work? Yes. Can we make some pips out of it? Yes. Would we make it all of the time? No. And no need to try to defend the strategy, right? So if you see this as a breakout, then you would be anticipating that everything here would give you a reason to buy, and price never bought, price sold. And once we got a close beneath, and I think I dropped this in the chat when someone was asking in SimplyPips, that once we get a break beneath the source, then we anticipate sells. So when we got a break beneath the source, Price came back to retest the source and we were sellers. Bad as it is, this move here is about 100 pips. If you had sat down the whole of this sell and you still got 100 pips out of the market, hooray. I mean, good. The point is, you just want to have a reason to go into a trade without necessarily gambling, without necessarily jumping in because somebody somewhere in one Telegram group said buy. If you have a just reason to go in for your buy or a sell, follow your strategy, right? Now, some other persons saw this area here as a stop hunt because there was an intersect between these two order blocks. In fact, if we go down to 15 minutes, let's call up another GBP USD. Call up another GBP USD. Plain. All right, so let's call up another GBP USD, Control Y, and come down here. You just have to find something that works for you. So here was where we had this order block responsible for the drop. So this gives us 1 minute, please. Properties. Go to read. 1 minute, please. I need to. Okay. I'm not getting what I need. Okay. So here, all right, I think it's not showing. I don't know why. Okay, so anyway, let's use horizontal line then, or a vertical line. So we're here. We go down to 15 minutes and look for our line here. So anywhere between this place, we would be looking for reasons to sell, right? I want you to follow me closely. There's something I'm trying to drive home here, and I want you to get it. If there's a difference between marking up after price action has happened and being in the heat of the market when price is actually playing out. If you were in the market and you were anticipating a sell here, you might have caught this sell sweetly. And what do we need to do? On 15 minutes, we use our LSB. Where is that? Okay. This date here was 16th. Insert high-low indicator. All right. So on this day, you would be looking for within this box here, this yellow box, you would have been looking for a reason to want to sell, right? And you would get that reason to sell off an LSP that would have occurred right here. An LSB that would have occurred right there. Above. Price came back down. If your stop loss was, this would have been the retest. LSB. This would have been the retest. came back down, went back, didn't take out your stop loss, and then dropped. So that was why I was saying that there's a difference between watching a video and being online live when the trades are happening. When the trades are happening, you are anticipating a sell around this point. Price doesn't really know that there is anything like a box there. Price came, went, took out liquidity or whatever it is, and dropped. You could have been in this sell also if you follow the LSP. Now, besides that, for those of you who like trading on the 15 minutes, we also use the TDI. If you use the TDI, you have a shark fin here. Sorry. You have a shark fin here. And we say we want to go in, for those of you who love using TDI, that if price approaches your area of interest for a sell, you only want to go in for a sell if you find divergence or shark fin. So we'll have a shark fin right there coinciding with this zone here, and that's a good enough reason to anticipate a sell. Right? That's I think, I don't know if Bobby is online. He wanted me to explain GBP USD. Right? Now, for those of you on modified IOF, I tried explaining yesterday that this rave amongst retail traders to try to discard everything they know simply because they see a strategy that looks interesting is killing, because you get to start afresh again every time. And I tell you, you always find another strategy. You will always find another strategy. Every successful person I know trading got to a point where they narrowed down on one strategy. They still join webinars like this, they still watch YouTube, but their main strategy doesn't change. What they do is that they find ways of picking one or two things from those strategies to complement whatever they already know. You need to have a backbone, something you understand at the back of your hands, something you've backtested over time, right? Then every other thing can just be an addition to give you more reasons to want to take your trade, your sell, or your buy, right? So if we go back to GBP USD on this particular day, and that's here, let's take out all of these things. Indicator, sorry, object list. Let's take out everything here. Now we have our BTMM moving averages. Let's go down to 15 minutes. What date was that again? June the 16th. We'll go back to 15 minutes on June the 16th. If you are here and you understand the traditional BTMM on June the 15th, you would clearly see a shift here that would have given you a reason to sell. Right? You clearly see a shift here that might have given you a reason to sell. And I think I promised somebody I was going to explain what source entry is on using the traditional BTMM. Let's call up GU again in my default window. Okay, I promised someone I was going to explain what a source entry is. And here you have a source entry. So GBP/USD, you've identified that GBP/USD is a downtrend. You identified it. For one reason or the other, you missed your entry, or for one reason or the other, you missed your entry, or you were not confident enough to pull the trigger, right? So what does the traditional BTMM tells us? When we have our 800 above the 200, above the 50, above the 13, and above the 5. I rarely use 5 these days, right? But if you have them like this, you are clearly in a downtrend. You are clearly in a downtrend. In fact, the rule is this: once the 50, which is the aqua, crosses the blue, expect a powerful trade the next day. That's the rule. Once the 50 crosses the 800, expect a powerful trade the next day, right? So here we are, an example of what a source is. Now I'm explaining source not on institutional order flow. I'm explaining source on the traditional BTMM, right? So this is a source. I'll take out the 5 for now. We'll have the 13. I'm in a downtrend and I missed out. When price trades back into my 13 moving average, and I see a bullish candle and an engulfing candle closing beneath my 13 moving average, with the 13 moving average cutting across both of them, like in this case, you enter your trade at the close and you should be in profit after 3 candles. If you are not, get out. That's a source entry, right? So this is a source entry. And you do this only in your kill zones. And ICT has done it so well that he taught us kill zone. This is the London kill zone, and this is the New York kill zone. So I have this source happening in the New York kill zone, the bearish candle and the bullish candle, moving average passing through both of them, engulfing candle, boom, closing, enter, sell. Here we have a source, right? But this is outside the Q zone. We let it be, right? Let's see if we have another source again. Here we have a source. Close of that candle, we go in for our continuation trade. In 3 candles, you should be in profit. If not, you get out. Bad as it is, we might have made 30 pips off this trade. But everything here stems out from the fact that we determined here's another source here, something that looks like a source. But we want to know our general direction first. So we might miss out on a trade. You could use, if you love using moving average, you could use, if you love using FIPS, you could. We get paid trading only when we get the direction right, and we come in at the time when price is moving. That is when we get paid. Now, so weave round, I try mixing ICT other blocks together with traditional BTMM. For some of us that are very visual, we like seeing moving averages. Well, here we are. If you have your 200, your 800, 250 stacked like this, you are in a, very defined downtrend. You should be looking for sells as price inch towards the 50 and goes down. You should be looking for sales, right? So I think I've explained, I've paid my debt in explaining what source is. All right, so let's see. So DJ Jags, to everyone, help me understand this system with the 15 minutes time frame. The 15 minutes time frame is get your order flow first on the higher time frame. Once you've gotten your order flow on the higher time frame, you now wait. That trade right there has 4 confluence. Okay. I didn't see this on time. Darren Flynn was trying to explain, I guess it was GU, that it had 4 confluence. There's fair value gap, there is IPL, there's order block, and there's sweet spot on the fib retracement. Darren, you have to come back and explain fib again. You know I'm not too good in fibs. So I have him next week if he's free. Could you explain more on the difference between weak and strong order block? Yes, I will explain that. When the BOE released interest rate decision on Thursday, GU wicked perfectly into an order block, give me bank's premium selling price. Oh, okay. That's Darren Flynn again. Yeah, okay. Akash, I'll unmute you now so you can speak. You can ask your question. All right, go ahead. You're muted.
Hi, Bishop Raj. As you told, like we do include bricks of the
Sorry.
previous candle in the large step total. So what if there are the body in place of the bricks before the candle which we are considering for large step total? Suppose like example, when the bullish
Sorry, I can't
market.
hear you. I can't hear you clearly. There seems to be some noise at the background. Hello?
Can you hear me now? Can you hear me now?
All right, make an attempt again.
Okay. Suppose like as you said in last step token, we do include the wicks of the body and the candle of its previous candle. But in case if we don't have the wicks of the previous candle and have body, like suppose in the bullish market structure, we do consider the bearish last step broken candle and its wick and the wick of its adjacent candle, right?
Yeah.
So if so in case of the adjacent candle, if we don't have the wick and we have the body, uh, then we do include the body of that candle.
Oh, okay. I think I have an idea of what you're trying to ask. I'm not sure, but just listen. If I'm sure I'll get it this time. Okay, so let's go back to. Let's come back here. So on the 15 minutes, we said, let's use this. We are anticipating a sell. When price finally breaks beneath 2, we will be anticipating a pullback towards 2 to sell. Now, this is what we expect. This is our breaker. We're anticipating price to trade back into the breaker and sell. Several times, price may never retrace back to the breaker. It just continues to drop. If your trading plan is to set a sell limit, once you see the order block, you will miss that trade. And unfortunately, there is nothing we can do about that. No matter the strategy you use, you will miss some trades. If you use fibs and you set your entry as sweet spot, price may decide to go to the sour spot and not come back. There's nothing we can do about it, right? So if you use sell limits, just put your sell limit, price may never come back. Now, in my trading career, I've had times when price breaks beneath and keeps dancing like it isn't going to come back for a retest. And I'll get too, agitated and just pull the trigger for a sell, and to look like the market maker was looking at me. And immediately I pull the trigger for a sell to come back and do a clean retest. And now I have a wider, stop loss, right? Because I came in midway right? And I didn't wait for that retest. So you need to pick one. What do you really want to do? Is it a retest? Wait for it. Some days you will miss it and it could be painful, but you just have to move on. However, a rule of thumb is this. If I get a close beneath my market structure and the number of pips with which it closes beneath, I'll pull the trigger and let it go. What I'll simply do is add that 10 pips to my stop loss. And remember, our stop loss is 2 times spread above the high, the peak formation high. Right? 2 times spread above the peak formation high. Now you need to be careful doing this with NZD pairs and AUD pairs, because that might mean that your stop loss might now be higher than what you traditionally take. So if your trading plan says I won't take a trade with a stop loss greater than 30 pips, now what I just said now may not just work, right? For trades like EN or GN or GA, it may work for GU and some other pairs. So you need to have that at the back of your mind. So if I'm going for an LSB on 15 minutes, let's take a scenario here. All right, say the price had been trading up and I'm looking for an opportunity to sell. This is the last bearish candle responsible for this high. So I'll mark up this bearish candle. Responsible for this high. Now, price broke beneath it. If I'm not confident with this, say I'm not confident about this break, but clearly this was a break and this was a retest. But say I was not confident about this break, and I was looking at this as my break in market structure, then my entry will be at that point, and the stop loss will be like 30 something pips, right? I have two options. I either trust the strategy and anticipate that price will trade back to retest this point and then drop. One. Number two, I can clearly see a fair value gap between this point and this. And that fair value gap is here. If price trades into the fair value gap, I can sell if I'm right there and I'm willing to pull the trigger. And if you love doing instant execution. However, if you trust the strategy, here you have your fill. And it always doesn't happen that way. It doesn't always happen that way. So you just need to pick one. You need to stick with one. What you need is a winning edge. At the end of the day, you would be profitable if your edge, if the strategy has an edge that makes you win, right? So here could have been the break, and this is a retest. But if you miss this, then you have other reasons you could go in. Now, what I said about counting number of pips from this point to this is about 11 pips. The question you should ask yourself, am I willing to add 11 pips to whatever I have here as my stop loss? Traditionally, you would have had from this point down here as your stop loss. Am I willing to add 11 pips to that? And if my answer is no, I let it be. You always have, if you go watch our videos, I think Darren Flynn gave a scenario where if you have that, you have a form of re-entry, and this could have been a good re-entry, right? My network went off at a point in time. Am I still audible here? Am I still audible here? All right, so yes, okay, so let's move on. Let's try and wrap this up. So that point could have been your entry. Now, if you hurriedly jumped into the trade somewhere here, you would have been in profit. It took you back straight to entry. So it's best to just pick one and stick by it. You will miss some trades. right? But if you use BTMM, the traditional BTMM by Steve Monroe, now you have the opportunity of adding your 13 moving average, now you have the ability of adding your moving average. And you'll be looking for your 13 moving average. Sorry. You'll be looking for your 13 moving average. Remember, you have identified from the higher time frame that your order flow is bearish. So you're looking for your 13 moving average. Then you look for something like a source. Once you get a source entry, so you say you've missed this, and because of that, you are not confident to take this other trade, you keep going. You might find a source entry to go in for yourself, right? The most important thing is stalking few pairs, so you get to know what they're doing. Stalk them enough, you get to know what they're doing. If we don't chase 16 pairs together, then there's no reason why we shouldn't be profitable with this. Please, sir, can we look at CAD JPY on the 10th of June? And OB was created and it was never retested. Now price is moving in an upward direction. CAD JPY. Let's quickly look at that as a wrap up. I think after that we should be done. CAD JPY. Guys, you don't need more than 4 trades sometimes in a week to hit your, I don't know your trade objective anyway, but 4 good trades in a week, yeah, cool. CAD JPY, what date now again? CAD JPY, 10th of June. Are you referring to this? Who asked that question? Samuel, are we on the same page here? This CAD JPY. If we are on the same page, then what you would have seen, all right, so what you would have seen is that you saw this is the order block. This is the order block of interest in CAD JPY. Everything CAD JPY is doing here is consolidating. So we don't have anything to look at in CAD JPY. Yeah, this is the order block of interest in CAD JPY. This was the bullish candle responsible for this drop. Price has not come back to the test. If price for any reason comes back up here, we will be looking for reasons to continue the sell. But as it is right here, price has not retested anything of interest to us. We'll simply sit out CAD JPY, except if, of course, if you're in a trade prior to this time and you're still hoping that to pull down. Else, nothing more. All right, I think we've been able to answer some of the basic questions here. If we personally, my view is that sit down with one strategy long enough, there's no reason why you shouldn't. At every pair, we get to a point where it will consolidate and everything gets jumbled up and it looks like nothing is making sense. Every pair we get to that point, right? So if I take a trade the first time, SL, second time SL on a particular pair, anticipating a move, I simply just pack that pair aside and focus on other ones, right? We have A to Z. If option A fails, move to B. If B fails, move to C. I'm not tied, like my destiny is not tied to any pair. So if I get into a pair and I don't understand what is happening, the candlesticks are not too smooth, I let them be. You want to look for things like what GU and EU did this week, very clear signs to go in, right? And you pull your trigger. Those are the ones you want to look out for. See EU this week. EU, where are you? All right. So let's look at this again. What have we been having? Higher highs, higher highs. And notice how price in all the rise never broke our structure. This was the order block responsible for that rise. This was the order block, the week down, responsible for that rise. Price never broke. You want the ones that are clean. But remember, we said something. We don't know when we're going to have consolidation. But when you do get one and you're able to spot it after a while, you let it be, because this strategy is a trend following strategy. Trend following strategy. Right? That was the order block responsible. Notice how price cleanly was obeying this stuff. Right? That was the order block responsible. Price came back down here, never really gave a retest. Notice the order block responsible for that high. Notice this order block responsible for that high. Right? So let's not make these too clumsy now. So that leaves us with this order block here, bearish candle responsible for that high. So this becomes the bearish candle responsible for that high, which later on became the breaker. If you follow only EU and GU, like Michael tells us he does, it might just be good enough. And here we have the source. This was a breaker. Right there we have the source, the highest point. Bearish candle response for that high. Breakdown. Price came back to retest the source and the breaker. Gave us one reason to sell from here. If you missed out on that, gave you another reason. So I see people try to mark up order block from the right. No, you check what price has been doing prior to that time. You mark from your left and try to go right with it. So if you're doing back testing, you don't trade from your right into the left. You trade from the left to the right. So here, price traded into it, dropped, traded into it, gave us another reason to sell, right? if you understand the concept I just explained a while ago, you would see a clear-cut trade here, right? Let me take these two out. I told you that if you find a large candle engulfing, you could basically clone the whole of this move. Right? You could clone the whole of that move. Notice how swiftly that was. Right? What was going to be your entry from what I explained? The tip of that point, or the threshold of the other block, which also seem to coincide. And what do you wait for? You wait for a retest of that other block or the threshold, and you drop. That should give you 3R. So if your entry was from this point, your stop loss a little bit above, maybe above that week, you would have been having 1R as your stop loss. When you got here, that would be 1R take profit, 2R take profit, 3R take profit. If you risk 1%, this trade is 3%. If you risk 2%, this trade is 6%. But first, you have to define your order flow. Once you get the order flow and there's a large candle leaving an area, leaving a fair value gap, go watch our order block theory. Michael says, when price trades back into the order block, back to fair value, we anticipate a sell. So now with institutional order flow, you've been able to establish that you are bearish, you saw a breaker, you saw all the jargons we normally mention, take it out, right? So what I think everybody here needs to go work out is how you take out your profit. How do you take out your profit? So I'm promising us 3 webinars now. I've told us I'm going to try to get Darren Flynn on or Prof to come tell us how to grow small accounts. How do you compound small accounts, right? I see people with $500, $300 trying to trade gold. Gold is not meant for those kind of accounts. Leave them alone. Go trade EU, AU, NU, GU, and be safe and grow the account gradually, right? If you came into Forex because somebody told you you could turn $200 to $1 million and live in a beach, you've been lied to. The reality is, yes, you can compound it, but you might need to wait for 2-3 years before it turns out to be anything tangible, right? So I'll also discuss take profits. How do we do that? So I think we have to wrap it up here. Thank you all guys for coming online. Have a wonderful evening. If you have other questions, drop them in the chat box. In the Telegram, I don't have to be the one to respond. Every one of you here can respond to the questions. And let's have a wonderful, wonderful weekend. Thank you, guys.